We'll begin tonight with Nigeria's refusal to join an international agreement that has several other countries of the world sign up to a historic deal to ensure big companies pay a little fairer share of tax. Well, some 136 countries of the world agreed to enforce a corporate tax rate of at least 15%, as well as fairer system of taxing profits where they are earned. The decision follows concerns that multinational companies are rerouting their profits through low-tax jurisdictions to cut their bills. The Organization for Economic Cooperation and Development had led talks on a minimum rate for a decade, saying that the deal could bring in an extra $150 billion of tax a year, bolstering economies as they recover from COVID-19. Well, the move is expected to hit giants, that's digital giants such as Amazon and Facebook, as well as firms with global sales of about 20 billion euros and profit margins above 10%. But critics have said that a 15% rate is too low and firms will get around the rules. Nigeria, Kenya, Pakistan and Sri Lanka have not yet joined the agreement. And to discuss Nigeria's position as well as its implications on the economy, let's bring in a Rise News analyst, Dr. Sam Amadi. Dr. Amadi, thank you so much for being here. Well, this is a deal that has been tagged a historic one. What are the reasons why Nigeria is not signing up to this deal, at least just yet?
Well, first is that this has been in the making for long, primarily driven by the G7, G20, and the US, of course, and now OECD countries, and then getting signed up from different other countries outside the OECD. But clearly, the historical origin of this is an attempt to normalize minimum corporate tax as a way of also dealing with companies that are shipping abroad, registering abroad, and evading tax. So part of the tax social security policy for developing countries like America is to capture more of these big giant companies that probably find a way to take their operations, register themselves outside the shore and don't pay. So this first creates a prospect by which especially digital companies that have multiple operational processes and they all cut across countries. So you have a fair way that most countries will also benefit. And again, but why is Nigeria not in this game? First, for now, I think most countries that are trying to use tax policy, tax exemptions, and all kinds of to attract investment would be kind of feel that this is hard on them because they're going to be the ones who probably, take for example, Shell. Okay, so at some point, Nigeria cannot get more investment by lowering tax because there will be some sense in which you have a minimum. Now, that minimum means that if you look at these tax exemptions, those investors who will have come to Nigeria will know that they're going to be trapped by this 15% after the threshold. So irrespective of what Nigeria gives them, they will now likely encounter the incentive for preferential treatment because there will be some degree of a minimum threshold. So if Nigeria is going to tax them like 3%, which could be a boost for getting them to be in Nigeria, then they are going to still be subject to a minimum of 15% tax rate. So in this sense, countries that think that they are likely to benefit from this evasion of high tax countries are less reluctant to sign up. So that's one especially one I just not signing up. Although IMF argues that this could raise the whole tax revenue and has a way also of improving what they call minimum tax even domestically. So many countries are setting up minimum taxation rates that help them to get more revenue and discourage a sense in which multinationals are shopping for convenient countries where they can evade tax.
Right, so Nigeria has actually been hailed by Action Aid Nigeria. They are saying that, they're commending us for not signing up, at least just yet. But what are the implications of not signing up? We see that Nigeria, Kenya, Pakistan, and even Sri Lanka are yet to join that deal. What are the implications, especially on the Nigerian economy?
For now, it means that probably we can free ride. But at a point, how this works, at a point, it might have implication for how Nigeria, gets to be seen in the global economic market. So what can we lose? Basically, also, it's not a win-win. For example, it means that some of the companies, Nigeria might actually benefit from some of the companies, like digital companies like Amazon, Facebook and all that, that are not actually based in Nigeria, but whose operations derive revenue from Nigeria. Now, under this regime, Nigeria will be subject. Nigeria will be in a position to receive some tax benefit for those transactions, revenues acquired. So if you don't sign up, we will likely not benefit from that. But again, this is the beginning of this regime. Many countries sign up at a point. If the pressure to sign up might be more than the pressure not to sign up. But at this point, I think it's tactical that we don't sign up first. We're going to look at the impact on revenue, because essentially, then that presumes that Nigeria is going to be an attractive place for doing business. Because if the benefit of not signing up is that, look, you're going to be a place that companies that want to get out of a higher tax regime in Europe would consider you, because you're not under obligation to have that 15% tax rate taken from them. But if you're a country that kind of your costs are more in terms of insecurity, political risk, even ease of doing business, then it might actually offset the benefit that they will get from coming. So it depends on, are you going to take advantage of what is going to be an attempt by corporations to try to evade as much as possible this much more onerous tax regime. This helps international taxation. Corporate taxation has been in disarray. It's helping to shape it up, reform it, but countries like Nigeria arguably may benefit for not being part of that regime, all depending on whether we can create the environment that can benefit from this.
But we'll wait and see if we eventually change our mind and join this. But in the meantime, we're speaking about tax. Well, the Federal Inland Revenue Service says Nigeria now has 41 million taxpayers. At a public presentation and breakdown of the 2022 appropriation bill, the Federal Inland Revenue Service Chairman Mohammed Nami says despite the number of taxpayers, Nigeria still earns lower than what countries with similar indices across Africa generates from personal income taxes. While giving a breakdown, Nami says 4.2 trillion naira was the total tax collection up until September 2021, adding that oil-related taxes accounted for 22%, which is 950 billion naira, while non-oil taxes generated within that period was 3.3 trillion naira. Well, at the second quarter of 2019, the FIRS says Nigeria had only 20 million taxpayers, with at least 49 million people reported to be evading tax payment. Amadi is still here with me. Let's have a conversation about this. We've seen, our tax bracket really expand from 21 million just under 2 years and now to 41 million. Yet, not enough to help us offset the budget deficit? I
think they have done the first thing, which is expand the tax net. But the problem is that most of them are the poor wage earners who are getting more into the tax bracket. We need to see the difference here is that the big billionaires, millionaires, and big corporations probably are not paying as they ought to pay. So take South Africa, for example, that has about 50 to 60 million people and of only 4 million taxable subject persons, but they are receiving 16 billion. So the question here is, you're talking about big corporations, you're talking about much more less exemption from taxation. That people have argued that too many exemptions. Take for even VAT. Airlines and several other places, people are arguing, why should there be such exemptions in VAT? So clearly, they need to improve in terms of further expanding that net. And again, make sure that the net includes people who ought to pay and pay more. Again, people have talked about VAT. VAT, for example, 7% in South Africa is about 15 to 17%. So you're looking at tax rate, you're looking at tax bracket. You're also looking at whether you are also taxing people who ought to be taxed properly. So that's the three dimension, is that we're expanding for 41 million out of 210 million approximate. It's not a bad tax bracket. It's an improvement from 20 million to 41. So that's good. But the question is, can you improve the revenue? And that means some people are not paying as they ought to pay. Too many exemptions, probably for you to look again at those exemptions, especially as it relates to corporate business. Again, are we also sure? For example, we're talking about native, talking about over how many billions being owed by corporate entities in the extraction industry. Now, seems like there are many people who are not remitting enough, who are not paying enough. And again, we have to look at the transparency of the tax regime itself, because collusion and all kinds of gaps create opportunity for both legal evasion and even illegal, failure to pay tax. So it's a multiple of things, but the basic issue that we're not getting enough as we ought to get from tax. And again, ultimately, governance. People, how many people in the informal sector can you get to pay? Can you formalize those sector without constituting a hindrance to business, facilitating their income, and then have the capacity to engage them with tax, options? But the point is, if we're not governing well, if we're not having government presence, if we're not providing services, the basis for expanding or increasing tax or creating another tax could be a problem, because probably you don't have the legitimacy as well as effectiveness to get people to pay.
Right, and of course, looking at the numbers, oil sector is still actually contributing 22% to the tax, whereas non-oil sector 3.3%. One looks at the diversification of the economy and all. Anyway, Dr. Sam Amadi, thank you so much for your in-depth analysis tonight.
Thank you.